Hey, this is Steve Boyer and Kelly Jacoby from Log Pond Realty. Welcome back to Pond Points. We have a special guest with us. We have Luke Stevenson from Amerifirst Mortgage. We're here to talk mortgages. Welcome, Luke.
Hey, thanks for having me. It's good to be here.
So Luke, we kind of wanted to pick your brain today. A lot of our clients, everyone's hearing it's a great time to buy. Interest rates are low. We need to work on inventory, but we're working on that. But a lot of people think they need to wait until they have 20% to put down before they can even look at purchasing a home. So can you tell us just a little bit about that today?
Yeah, absolutely. That's certainly a big misperception in the market today and for potential buyers. The reality is, and the truth is, you do not have to have 20% down. In fact, you can have as little as 0% down in some cases. Now, we'll save that for another topic another day, but today we're going to talk about some options that are less than 20%, like 5%, 10%, 15%, and see what that looks like over the long term and what it does to your payment.
That'd be great. Thank you.
Awesome. Let's go into an example.
So yeah, let's hop into this. So what I'm going to share with you today is here on your screen, and this example here is going to show a lot of different down payment options. 20% will be one of them, but also 10, 15, 5. And we're going to walk through it and show you the difference in the payment and what else is entailed whenever you put down less than 20%. And we're going to get to that here in just a second. So this is our example here that you see on the screen. Let's just play pretend and say that you're looking at a $400,000 house. And let's also play pretend and say that the taxes on this house are $2,400 a year. Your homeowner's insurance is $100 a month. And we're going to plug in several different loan scenarios into this home purchase. So we'll start with 5% down here, then we're going to go to 10%, 15%, and 20% down. I'm going to keep scrolling here, and we're going to see a payment breakdown and cost breakdown of all of these scenarios. So here is everything side by side. And one of the interesting things that I want to point out is, like we said at the beginning of this call, is that 20% is not a requirement. So how is that possible? Well, there's something that's called PMI, and PMI stands for Private Mortgage Insurance. And so PMI essentially is applied on conventional loans where 20% down is not being utilized. And so whenever you put down less than 20%, private mortgage insurance comes into the equation. So what is it? Essentially, PMI is a monthly insurance premium that you are paying as part of your monthly payment for a specified period of time, or until the loan amount reaches a certain loan to value of the original purchase price or appraised value. And so in these examples here, we're going to come down here to the mortgage insurance section right here in each of these scenarios. And I'm going to highlight these for you. So in this 5% down situation, you only need 20 grand on a $400,000 house. And this mortgage insurance quote here, it's estimated. It's not going to be exact. Mortgage insurance is based on loan to value, total loan to value. It's based on credit scores and debt to income percentages. And so all those things will play into that. But this gives us an idea of where we are at 5% down. So at 5% down, you're going to pay approximately $120 a month in PMI. And your total monthly payment will be right here in the total monthly expenses column. Once you add in the PMI, the principal and interest on the loan, as well as any potential homeowners association dues and any homeowners insurance. And so in this example here, you see that your total payment is $19.97 a month estimated, right, as an example. In the 10% column, you're going to put down an extra 20 grand. Your payment's going to drop about 120 bucks. And then here in the 15% column, you're going to put down another 20 grand, so we're at 60 total. And then this is your total monthly payment. Obviously, your monthly payment is going down because you're borrowing less, right? Mm-hmm. And also your PMI is as well. And then here in the 20% column, here's your total monthly payment estimated. without any PMI because you're putting 20% down. So I'm going to scroll down here one more time, and we're going to go to this bar graph to help paint a more visual picture of what this payment breakdown equals and what the differences are. And so one of the things that I want to point out in this example is the difference between 5% and 20% is right here. You've got $369 a month difference between a 20% and a 5% down payment. Now, what's interesting about this is the difference in cash that you now have available to you. So even though your payment is $370 a month more, you're also 20% down up here. You also still have $60,000 in the bank, though, if you had 20% down, right? And so in today's interest rate environment, sometimes it just depends on what your monthly budget is, but sometimes it might make sense to put less down.
Yeah.
Whether you have the choice or you do not have that choice.
Yeah.
And so at the end of the day, how long will it take to recoup this cost?
Yeah. And I think another way to look at it, Luke, is if you can scroll up to the screen above, if you think about it in terms of how long is it going to take me to save for that 20%. Let's say that I'm at 10% down and I've got the 40,000 that I can put down on in this example. But how long is it going to take me to save another $40,000 and potentially miss out on a low mortgage rate environment that we've been in? Because we don't know what's going to happen to mortgage rates tomorrow or the day after.
Sure.
And so being able to save $40,000 is huge.
Absolutely. You're exactly right. It does take a while. And knowing that even if you have 10% down, you could still just put 5 down and keep that cash in your pocket because it is so cheap to borrow money now based on historically low rates. And so that's a great point. And the other thing too here is the difference, the amount of time it would take, again, to recoup that cost. So if we take, I'm looking down at my calculator here, if we take 369 and divide that into 60,000, which is the difference between 20% and 5%, it's going to take 162 payments to make up that difference. Most people, especially first-time home buyers, the average time that someone spends in the first home they buy is probably only about 7 years. And so it's give or take. It depends on the market and depends on where you live. But at the end of the day, no one stays in their home that long most of the time.
Yeah.
And so you and especially in an appreciating real estate market, it begs the question, right? What makes the most sense?
Right.
That's exactly what I was going to say. With the values increasing in our area as quickly as they are, and with interest rates being so low, if you can borrow, if you only need to, if you can put 5% down now to get into that $400,000 house in a year or two, we expect, that value to rise, that you've got that equity in that home too, to help you towards your next. So to look at what the market values are, that they're definitely increasing in our area. And with it being so cheap to borrow, I mean, it makes sense to do whatever you can to get into something now with rates being right. I
was going to show one more thing here. This is an analysis that sort of you hit on, Steve, is the cost of waiting. So I'm going to click on this little clock here, and we're going to just take a look at, and this is based on specifically Wake County market data. And it shows us what things could potentially look like in the future. Obviously, this is not a crystal ball. There is no such thing as a crystal ball. But at the end of the day, this is based on historical data that we would anticipate over the next 4 quarters of 2021. And so to your point, Steve, right here, look at the total cash to close, over 6 months, over 1 year, over 2 years, there's going to be an increase in rate, more than likely. There's going to be an increase in value. So this $400,000 house in 6 months might not be $400,000 anymore.
Right.
In 1 year, it just keeps going. And so This is just a good visual to show what the cost of waiting actually is. And well, not actually, but estimated to be what it could be.
Right. Luke, this has been a great session. Thank you very much. This has been really enlightening for hopefully everybody.
Yeah, Steve, Kelly, thanks so much for having me. At the end of the day, if you have any questions or if there's any thoughts that you have, please reach out to me, email, phone, which we'll put here at the end of the video. Please let me know. At the end of the day, no one should go through this process without having a relationship and knowing a lender. And obviously, I'm happy to be that person to help you figure out the best choice for your new home.
Thank you.
Thanks. And this is all we have this week for Pawn Points. We hope you join us next week for another edition. And as always, we welcome your questions, your comments, your likes on social media, and we hope you stop back next week for another edition of Pawn Points. Bye now.
Bye-bye.
Bye.